The White House called it a victory. Markets called it suicide. Trump had just announced a $2,000 tariff dividend for every American, funded by debt the U.S. didn't have and confidence it couldn't borrow. Within hours, the dollar cracked, gold hit $4,200, and Beijing ordered another surge in state gold purchases, enough to drain London's vaults for weeks. Washington was printing money to prove strength. China was buying gold to prove time was on its side. And by the next morning, traders were whispering the unthinkable. Had America just financed its own collapse? Reuters data showed that total tariff receipts since 2021 were just $150 billion, far short of what was needed to cover the dividend. The gap meant one thing: more bond issuance. Bloomberg's November auction review showed widening tails and weakening demand. Pension funds and money market vehicles bound by new liquidity rules were forced buyers, not volunteers, because every borrowed dollar now tested how long the world still trusted the dollar. But who was really buying, and why now? Foreign demand was slipping away. Treasury data revealed China's holdings at $756 billion, the lowest in 16 years. Japan and UK custodians picked up part of the slack, but trading desks told Reuters that much of it was custodial flow, not conviction buying. The question wasn't who financed America, it was who still believed in it. Meanwhile, across the Pacific, Beijing was moving in the opposite direction. The People's Bank of China had increased gold reserves for 18 consecutive months. IMF tables from October placed China's official holdings at 2,245 tons, an all-time high. Yet analysts at UBS told the Financial Times that when commercial and state-backed holdings were included, the true figure might be closer to 4,000 tons. But if those numbers are right, China's reserves aren't rising. They're doubling underground. That mattered because gold's climb above $4,100 an ounce in early November wasn't speculative. It was strategic. Bloomberg reported that central bank purchases were the largest in half a century, led by China, Turkey, and India. The World Gold Council estimated that official buying made up nearly a third of all global demand this year. By contrast, U.S. output was collapsing. Geological survey data showed American gold production down 32% since 2020 to only 158 tons annually, while China mined more than twice that, over 370 tons. Each new bar refined in Shandong or Henan was another ounce that would never reach Western vaults. We export electronics, not bullion, a Shanghai Gold Exchange official told Reuters. That shift mattered because every ounce kept inside China weakens the leverage of dollar collateral abroad. The White House insisted tariffs had generated trillions in investment, yet Treasury ledgers told a different story. Bloomberg's fiscal models showed the proposed dividend would expand the deficit from $1.8 trillion to $2.2 trillion within a year. The Financial Times cited internal Treasury emails warning that new bond sales were cannibalizing private credit. The memo's conclusion was blunt. Domestic savings were being converted from growth capital into government survival. Because, borrowing cost decides who controls the next decade. Consumers felt the squeeze first. The Peterson Institute calculated that tariffs had lifted average import prices by 8% since 2021. The dividend was recycling inflation, returning dollars that households had already paid in higher costs. University of Michigan data showed consumer sentiment at its lowest level since 2020, while credit card delinquencies rose above 3.5%, the highest in 10 years. In televised remarks, Bessent called the plan liquidity sugar, not nutrition. Trump countered that the dividend would lower the debt through growth. Bloomberg's budget team ran the math. It didn't work. The more the U.S. borrowed, the faster bond yields climbed, driving up interest payments and widening the deficit again. If the math doesn't add up, what keeps the bubble inflated? Investors moved to protect themselves. Gold-backed ETFs saw $8 billion in inflows over 2 weeks, according to Refinitiv. The Shanghai Gold Exchange processed more international trades than at any time since 2020. Chinese state banks began offering yuan-denominated gold accounts to foreign clients, a move the FT called a direct challenge to London's bullion dominance. That mattered because it turned China's domestic metal into global money. Then came the first geopolitical echo. Cambodia announced it would transfer part of its 54 tons of reserves to Shanghai's bonded zone, calling it secure and tax-free. Bloomberg noted visits from officials of Laos and the UAE days earlier. Each relocation was small but symbolic. Wealth edging eastward. Metals. Focus data cited by Reuters suggested that nearly 900 tons of sovereign gold had moved from Western to Asian vaults since 2022. Western custodians, London, New York, Zurich, still held a majority, but that majority was shrinking. Less gold under Western control meant sanctions carried less bite. Inside Washington, the optics turned surreal. Trump repeated that trillions had flowed into the United States through tariffs, but the Wall Street Journal found net foreign direct investment down 14% year to date. What had actually risen were Treasury holdings by domestic funds, an accounting illusion that masked evaporating foreign appetite. Bloomberg reported that money market assets hit a record $6.2 trillion, with most of it in short-term Treasury paper now covering nearly a quarter of federal outlays. Each new auction drained the same domestic pool. The system really was just feeding on its own liquidity. Beijing was building the inverse. The Financial Times revealed that the People's Bank had expanded gold collateral lending among state banks, using bullion in place of treasuries for interbank liquidity. That mattered because it basically replicated the structure of the dollar repo market, without the dollar. By the third quarter, Chinese refiners processed nearly 400 tons of bullion, which was up 17% year on year. Meanwhile, United States mint sales of gold coins fell by half. The contrast was striking. One nation converting paper into metal, the other converting metal into promises. JP Morgan strategists warn that if gold passed $4,200, central banks could mark massive balance sheet gains, rebuilding reserves without debt issuance. Beijing holds the option to reprice its assets in metal, they wrote. Washington, reliant on bonds, held none. Auction stress confirmed it. Reuters reported that the 10-year Treasury sale on November 7th had the weakest demand since 2011. Dealers were forced to absorb leftovers, pushing yields higher. Within hours, gold futures jumped $80. Debt up, metal up, cause and effect aligned. Behind closed doors, Besant told Senate staffers the world was dividing between those accumulating finite assets and those manufacturing infinite liabilities. The Wall Street Journal quoted the line the next day. Traders treated it as quiet dissent from within Trump's own cabinet. Yet Trump doubled down. At a rally in Pennsylvania, he called gold's rise proof of America's confidence. Reuters quoted a former Fed official responding, "Confidence leaves before the currency does." China's numbers undercut the rhetoric. Foreign exchange reserves totaled $3.3 trillion by October, including about $200 billion equivalent in gold, double the share 3 years earlier. Each ton removed from Western custody reduced Washington's leverage in sanctions diplomacy. The Shanghai Futures Exchange then launched yuan-settled gold contracts deliverable in both Shanghai and Hong Kong. Bloomberg described them as the final link in an Asian bullion circuit operating fully outside dollar clearing. That mattered because it redefined what counts as safe collateral in global trade. As gold strengthened, capital rotated. Bloomberg tracked U.S. venture funds allocating record sums to commodity ETFs. Nvidia's market cap fell 12% in a month, while Shandong and Perth mining firms posted their best quarters in years. Capital was fleeing abstraction for substance. The loop fed itself higher yields made borrowing costlier, weakening the dollar, which lifted gold further, inviting more Asian buying. IMF reserve composition data showed the dollar's global share slipping below 57%, the lowest since 1995. Inside the Oval Office, aides tried to square contradictions, a president promising free money, a treasury issuing record debt, and a public losing faith in its currency. Bloomberg Intelligence estimated another $1 trillion in issuance next quarter alone, because every dollar China stops buying costs Washington billions. China's state media seized the moment. CCTV celebrated new vaults in Shenzhen and Pudong, each capable of storing thousands of tons. Strategic metal security, they called it. Western analysts saw something deeper, a statement that power in the 2020s isn't measured by armies or apps, but by what sits in the vault. Cambodia's relocation sparked imitators. Reuters reported that Kazakhstan, Egypt, and Serbia were exploring similar agreements to store part of their reserves in China. Combined, the amounts were modest, under 200 tons, but symbolically huge. The migration of trust had begun. At home, the tariff dividend fractured public opinion. Morning Consult found approval above 70% among households earning under $50,000, but under 40% among the wealthy. Economists dubbed it redistribution theater. Prices hadn't yet risen, but expectations had. And, expectations move faster than reality. The Federal Reserve stepped in, signaling it would delay rate cuts to defend stability. Equities sank. Gold rallied. Policy was trapped between inflation and insolvency. If one side gave way, the other would break. Across the Pacific, Beijing projected calm. Its financial press described the West's turmoil as paper fatigue. To investors watching yield spiral and bullion soar, that phrase carried quiet menace. The Financial Times summarized it in one line. While Washington prints promises, Beijing mints collateral. And now the question hangs over both capitals. If China no longer needs Washington's permission to borrow in dollars, who really owns the system now? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.